Good morning, everybody. Welcome to the Ag Economic Dialogues. I'll be chatting here in the background. Please continue to visit out there. We're in booth 216 at Dakotafest, so this is fun. If you're on Zoom, we've got a couple participants out there already, so you should be seeing the slides. If not, contact Heather, and we're just going to get rolling. We're going to take a look today at some of the market risk management. We're going to take a look at a little bit of corn, a little bit of feed stuff, and a little bit of cattle. Looking ahead to the fall months. There we go. On the corn side, we've got the national picture, but we've also got a local picture, the South Dakota picture in particular. We'll take a look at the tight hay supplies briefly, and then we're going to look at cattle. Cattle, we've got lower supplies going forward, but we've also got substantial risk. The risk is coming from two parts. One, the cattle side of things, the demand for cattle, but then also the feed side of things. What is the price of feed going to be? Or what's that feed situation look like as we get into the fall? At the national level, so starting very big picture in the US, I want you to back up and think about last year. Last year, about this time, price of corn was very low, relatively speaking. And then there was crop production reports came out, and the trade news surprised the market again and again and again, taking that 2020 corn production estimate continuously lower and lower and lower. About this time, there was a derecho storm that went through Iowa, for example, and then there were lower yields here and there. All that contributed to lower corn production nationally last year. Fast forward to this year, we've got crop production up slightly compared to a year ago, and that's part of the story. So there is more corn expected nationally than last year at this time. Higher supplies should mean lower prices, and that's reflected in the futures market. Two other aspects at the national level last year as well. The surprise after surprise, more corn moving into the export market. A lot of that went to China, and so we've got that situation for this year. They've got that number back down or backed off a little bit from last year, but those were the two factors: big supply, surprise last year, and the run up in exports holding up or giving a lot of price support for corn. Now, at the national level as well, one thing we do tend to take a look at is the price compared to the ending stocks to use ratio. So I've got two things plotted on this chart. One is sort of very, very old data in a very old supply situation. Predominantly, it's years pre-ethanol, and that's roughly pre-ethanol. So during, prior to say 1980, prior to 2006, you got those blue diamonds going across the bottom. Is that an old song? Blue Diamonds? Should be. We're going across the bottom there. We got those blue diamonds. I don't include those in the calculations, but you can see no matter what the stocks to use ratio was going across the bottom, big stocks, low stocks, in between stocks, price of corn tended to be $2 to $3. Then you fast forward to the, let's call it the ethanol era, the last 15, 20 years. So from 2007 to date, the tighter the stocks to use situation, lower the stocks tend to have a higher price. Now, for folks here, Heather says, don't use my pointer. I'm going to point out one little figure. That's right now, okay? So the price isn't as high, given the stocks to use, as the trend would suggest it would be, or the price could be higher than currently, and it shouldn't be a surprise or wouldn't be unrealistic given what we've seen over the last 10, 15 years in the corn market. Now, this is the stocks to use. Got to take that with a little bit of grain of salt. It's hard to forecast with that and make projections, but it is useful for explaining we've got a tight, relatively tight corn supply situation, and that's helping keep price high. In South Dakota, wanted to point out a couple things. If we look at This year, so this is the fresh numbers from the crop production or the NASS report from a week or so ago. But just for perspective, what is that yield looking like on for South Dakota at the state level? That 130 bushel an acre figure is there. It's not down as low as 2012, 2006, 2002, or other more recent broader drought years at the state level. So some of that I'm hearing, you've got genetics, you've got the timing, different things, but that is the yield projection as of now. That lower yield is offset quite a bit by the huge increase in planted acres. And I throw this in here for a couple of reasons. One, just to show the absolute level of planted acres at 6 million, or at 6 million acres in South Dakota. That would match the level in 2012, 2013. Also on there for perspective, look at the harvest line going across. So what happens in drought years like 6 and 12 to some extent, that's when you have a lot of acres abandoned or converted over to silage. And that's where we're at. What does that look like for the remainder of this harvest season? There can be a big shift to silage acres, for example. And then in a typical year, you'd have 300,000, 400,000, 500,000 acres go to silage. And then in drought years, you can have a substantial 10 to 20% of the crop acres have gone. But that's happened when the overall acres level has been lower at the state level. So lower yields, higher acres. So I zoomed in a little bit just to see, do we need to be concerned about having enough corn for feed needs at the state level? Is there enough corn for ethanol needs at the state level? I think the quick answer at this time would be yes. Corn production at the state level, 750, 760 million bushels would put slightly above last year's level and in line with the last 10 years. So there's not, just from a raw sheer bushel number, it's not a chaotic situation or we're going to run out of feed tomorrow situation at the state level. Now, the further north you go, you've got substantial pressure coming out of North Dakota, and you go east, you got substantial pressure in Minnesota with reduced production levels in those two states in particular. So that's going to feed into this going into the fall. Two other things on corn. One, basis. So we've had cattle feedlot workshops and things here lately. What's the feed situation? What are we going to see for basis? Currently, you've got the sharp break. You've got a premium for old crop prices, and then basis appears to be, at least with the forward bids, tighter or a narrower basis than we typically see. A more narrow basis already than last year at this time. So from a feed buying perspective, that tight basis is not good news. At the same time, if you can hold off for those feed needs, you do have the break between the old crop and new crop. The other thing related to feed is a limited amount of carry in the market. There is a premium as you go from December to March, for example, on the board. So if it would pay a seller of corn to store, it would also pay a buyer of corn to store. But I think the combination of the expectation of a price decline, basis already strong, probably hard to increase or strengthen that basis further when you think about new crop. And then a limit to carry in the market would be some indicators of going hand to mouth on feed needs, corn in particular. So buyers of corn, maybe think about that. what it would mean in terms of not laying in a full year's worth of corn supply needs. And all that's flipped on its head if you're dealing with raising your own corn and trying to figure out what to do with it. The corn that looked good to me, I would say, is okay. What I've seen across the limited parts of South Dakota I've been through recently, the good corn looked okay. It did not look great. So there's already been silage cut everywhere from Phillip to Marshall, Minnesota. I've heard about some silage being cut. So that's in play, in process right now. Moving on. Soybeans, a different situation with soybeans. With soybeans, we went in with a tighter stock situation. The price is high, has remained high, but there's been fewer surprises and fewer bits of information about soybeans. So I'm just going to kind of dismiss the soybeans for now because there hasn't been much that's changed or been moving. The prices are high, and it's carried over into the feed side with higher soybean meal prices. The usage numbers are suggesting that looking at reasonable crush and back with ethanol or corn too, the one other piece on the corn side, ethanol production is looking to remain fairly steady. So there will be, or all indications are, there's ample protein supplies coming through the form of distillers and through soybean meal. Soybean production at the South Dakota level, just for comparison, down slightly as well. Again, yields are much lower than last year, much lower than trend, much lower than initial expectations, of course, but acres are substantially higher than they've been in the last few years. So that's pulling the production level up, and thinking about like the soybean processing plants in South Dakota and in neighboring states. Doesn't seem to be at this time, you know, the soybean production looks to be there in terms of bushels, unlike just a couple of years ago, for example. On the insurance side, I just threw this out there. These numbers are from the other day. I don't know what happened to the market this morning or yesterday, but with the futures from February, the projected prices until the current level today, you've got the increase in both the futures price for corn and soybeans. So corn futures, for example, 460 at planting time, or in February, 570 at the moment. Basis, I would have been using a 45 under basis level for corn. That would be typical. That's the 5-year. I use a 5-year rolling average. So that's the 5-year average basis. October cash price, South Dakota versus futures. That's looking to be more like 30 cents right now based on those forward bids. That gives an implied cash price we're going into the year expecting $4.13, and currently you're looking at $5.40 using that taking that basis level off. Similar thing with the soybeans. The price level is higher and the basis has tightened, or looks to be tighter than the 5-year average. 91 under, looking more like 45 under, maybe 50 under, because you've got the demand coming from the PNW, and the corn and beans for export would likely come from the Dakotas and Minnesota to some extent. I mentioned the hay supply. A couple observations on the hay supply. First, at the national level, August is one of 2 months where you get a national hay yield estimate. So the first hay yield estimate nationally came in the August crop production report. That number, the yield number and the acres numbers for alfalfa and other hay were both lower. The implication for that was you kind of affirmed a tighter supply situation and higher prices at the national level. Heather, is there an issue? We're good? Okay. All right. So at the national level, tighter supplies of hay, meaning you've got some price pressure at the national level and certainly at the local level. So here's the South Dakota hay supply situation. Earlier in the summer, I was using some crop condition estimates and things. I was using about a 1.2, 1.3 ton an acre number for South Dakota. But we got a combination of the lowest hay stats for acres in recent memory. I'm sure you go back to the 1930s, there's maybe some comparison time in there, but the hay acres have just continued to dwindle and dwindle and dwindle at the state level. And then the yields came in. So this could partly reflect losing hay acres in the eastern part of the state. But the hay acre number, alfalfa and other hay, 1 ton an acre. So you've got a really, really, really tight hay situation in South Dakota at this time. The last time the hay yield was this low and the supply situation was this tight would have been 1976. And in that year is the only year I've seen in the data where the December 1 hay stocks exceeded supply. The only way to have December 1 hay stocks exceed supply is cattle don't eat anything from the end of, well, from May 1st until December 1st, usually not the case, or you bring in hay from somewhere else. That happened in 1976 at the state level, so the December 1 stocks exceeded supply. I don't think that would necessarily have to be the case, but the situation is similar in terms of the lower yield in acres and production for hay. What's different? You've got 2 million more acres of corn now than we would have had the last time this type of situation came up. So how many of those corn acres are going to go and end up in the feed market? For perspective, if we had a, so I went back and I compared to 12 and 6 and 2 again, just to kind of see. If you go back and compare to those years and you look at the crop condition index, the percent of the crop in the lowest quality category, so very poor, it was higher than it is now, but you've also got very few acres across South Dakota in the very good and almost no acres in the excellent category. The vast majority of the corn crop is in the fair category. That means it's in bad shape. It's not in as bad a shape as other years. So you try to read the tea leaves. What would that mean in terms of figuring out how much corn could be converted to silage? Well, start with 6 million acres. Figure 300,000-400,000 acres would normally go to silage for dairies and feedlots anyway, and then step back and say, what percent of the corn crops in the worst condition index, about 10%, if all of that corn could magically be taken for silage, you'd wipe out your feed deficit in a hurry from the hay situation being tight. And then you got to ask yourself, what's really going to happen? So if 5 to 10% of the 6 million acres goes to silage, that's another 300,000 to 600,000 acres in silage, and that ends up being a lot of silage production. How tall is that silage going to be? How many tons per acre is that going to be? You know, I've heard the estimates all over the board, but I haven't heard the estimates pushed down as far as would have been the case back in even 12 and much less so like the conditions in 2 and 6 in terms of height or tonnage likely out there in this corn crop. So those are some thoughts on the feed side, and it's a big unknown yet. How much of that corn would be converted over to silage and what that would do. But the more you see silage piles being the go-to in a given area for a given operation, you can be assured that if they're putting up silage, they've either got a lot of cows they're going to feed that way, or they're looking at calves, which should be supportive locally of the cash price for calves coming off later this fall. The other thing that feeds into the whole feed situation, no pun intended, it's early and it's hot, so that was just bad. The range and pasture conditions in South Dakota are very, very poor. Nationally, the pasture conditions on average are in tough shape because anywhere west of the plains states are in tough shape. Arizona, California, Western Colorado, Montana, the Northwest, all that factors into the U.S. pasture conditions stats. So nationally, pasture conditions are tough. In South Dakota, they're very, very, very tough shape. So that means limited pasture available, and either more feed will be needed, or some of the animals might head to the market that normally wouldn't go that direction. So earlier, heavier culling of cows, for example. Speaking of cattle, at the national level, cattle inventory is down. So this is July 1, all cattle down about 1% from a year ago. So fewer cattle, all else equal, tends to be supportive of price. Breaking that down into a couple different categories, feeder cattle supplies outside of feedlots. There are fewer cattle available for replacement to the feedlot than last year at this time. Now, last year, a little unusual, but it didn't affect this number. There were more cattle on feed last year, but fewer cattle outside of feedlots, meaning fewer cattle to draw from, should be supportive of calf prices this fall. The other thing, heifers held as beef cow replacements, that number is also down relative to last year, and a trend. So tightening of the cattle, a tightening in the cattle cycle, or the cattle cycle going down in terms of overall volume, which also should be supportive of price this fall and into next year. Cattle on feed is a little bit lower than last year at this time, but you can see it's running above the 5-year average, just for perspective. Then a couple of other ones. These are late additions to the dialogue deck from, we had the Midwest Outlook Conference earlier this week, where some of the extension specialists from around the Midwest gathered together. They gathered in Fargo. The beef observations, or a couple of observations from Kenny Bourdain out of Kentucky. He mentioned, and I used the LMIC slide here, he's been watching cow slaughter. Beef cow slaughter in particular has been running at a higher level all year. So some of this is cull cows coming from the western half of the United States. North Dakota has had a lot of cull cows come to the market. So beef cow slaughter is up. So fewer heifers outside, or fewer replacement heifers, and higher beef cow slaughter, looking at 1 to 2% lower beef cow numbers for 2022. Fewer beef cow numbers in 2022, smaller 2022 calf crop. That means you're at a point where you've got, if demand holds in there, should be a better year for cattle prices, slaughter cattle prices, and calf prices in from now forward, but certainly into 2022. So optimistic on price, not optimistic on the feed situation locally. The other thing that's happening, tied back to the price of corn, steer prices don't reflect this quite as much, but if you take steers and heifers and cull animals and lump them all together, the cattle dress weights have fallen. They've got much lower than last year, and then they've dipped below the 5-year average here recently. So higher price for grain has meant lower slaughter weights, and that feeds right back into the corn market. The feed demand in the WASDE, for example, is steady. They've got feed demand steady, but the indications are slightly fewer hogs, certainly fewer cattle. With fewer feed animals or animal units to supply and high price this last year, you're seeing weights come down. So shows up nicely in the cattle here. So you don't necessarily see it week to week in slaughter steer weights, but you start throwing the heifers in and these other animals, and it's pulling that all cattle weight lower. And that too, that's going to have two effects. One, animals are finishing quicker or at lighter weights. You're putting less beef per animal into the market, supportive of price, and going forward, less animals consuming the same amount of corn, or less animals consuming less corn. That's less feed demand, which would actually mean lower corn prices going forward as well. So a couple of mixed observations there, but it's starting to tell a pretty consistent story. The high feed costs are having an impact, and that's how it's playing out. So you've got a situation where you've got an incentive to put weight on cattle using anything besides corn. Just for perspective, if you were to put cattle on feed, say calves on feed this fall, do want to point out there's an old saw from I think it's a Mark Twain quote. January is a particularly risky month to invest in the stock market. The other months are February, March, April, May. I think that kind of holds true. If you look at the risk of feeding cattle, it's risky in January, February, March, April, May. This is the snapshot of how risky it is to buy calves in November and background them and feed them till March. You don't have to do anything, and the price can move against you in terms of $20 a hundredweight. If you do the math, $20 loss on the board, nothing you did, $20 loss, 8 weight, 800 pounds times $20, that's $160 the market moves and takes away from you. Now it can move in your favor, and over the last 20 years, about half the time it's gone up, half the time it's gone down, but there's substantial downside risk backgrounding cattle, calves in particular, through from November through March. So point that out. 2 ways to look at to offset some of that risk this time of year. If you find yourself with a huge silage pile and wondering what to do with it, buy some calves. That risk can be laid off with put options. The volatility in the market is not crazy high at this time, but put options would be a way to protect against the downside. And one other one I do want to spend a minute or two on. This is, if you've been a frequent attendee of the dialogues, you've probably heard the story about livestock risk protection by now. I hope to get around to the grounds here at Dakotafest later today and talk to a couple of more insurance agents about what's happening with this. But livestock risk protection is available on feeder cattle. So if you're going to background some cattle, LRP or livestock risk protection could be something to take a look at. It's sold by insurance agents, and it's just downside price insurance. So if you're worried about the price of calves dropping from, say, the feeder cattle market dropping from 160 down to 140, or from 170 down to 150, LRP would be something to consider. LRP this last year, 2 big changes. One, they really increased the subsidy. So it made it much more cost effective to look at and buy for feeder cattle and fed cattle and unborn calves, so next year's calf crop. All 3 have had a huge increase in volume of purchases or volume of head covered. The other change, so the subsidy is huge. The other change is they changed the coverage period for the last 60 days of holding coverage. Used to be 30, now it's 60. So you've got a 60-day window that you can sell the calves in, sell the backgrounded feeders into, and hold on to your coverage. So I'd encourage folks who are interested in that or want some more details, please get a hold of me and I talk through that a little bit more, because it's a subtle change, but one that's got a lot of relevance. If you're weaning early, or perhaps having to run out of feed in a backgrounding situation and sell them earlier, you do have that coverage in place for a longer period of time than before. That should be make it more attractive. Show you that subsidy prior to 2020. So if you used to look at LRP, if you looked at LRP back in 2005, for example, the subsidy was 13%. So by the time you finish paying for the subsidy and paying for the overhead on the coverage, it costs about the same as a put option. That is no longer the case. The subsidies now, the lowest subsidy is 35%, the highest is 55%. So the taxpayer is going to pick up about half the cost of you laying off the risk of backgrounding cattle. So I'd encourage you to take a look at that. So that means at the money put option, for example, if that would be $4 or $5 on the board right now, it's going to cost you $2 to $2.50 a hundredweight, or a lot closer to $10, $15 a head for eliminating, say, $160 worth of downside risk. It's starting to look pretty attractive. This is what happened when you put an incentive like a higher subsidy at work. You go back to 2003, 4, 5, less than 200,000 head across the United States were covered by LRP. 2014, following some price variability there, close to about over 300,000 head were covered. Last year, introduced a subsidy and 70% feeder cattle volatility because of COVID, and you had 850,000 head insured nationally using livestock risk protection. So subsidies matter, and producers and others, people, economic actors respond to subsidies. South Dakota, huge number of cattle covered by LRP. So this ends up being at 800,000 head, still a fraction of the U.S. calf crop, but it's starting to get a lot of notice and a lot of attention. And that year-to-date number, there's only a month or two there, so I expect that trend to continue this year. There's my contact information. If you're actually at Dakotafest, for the first time in a long time, I brought some business cards with me, and we're going to maintain our distance, and I'll throw you a business card if you're interested, and that's how we're going to handle that. I'm looking to Heather. I'm done with my canned remarks. Do we have any questions, either online or remotely here? They're going to catch me afterwards. That's going to be fine. Hey everybody, thank you for coming out here today. If you're online, it's not too late to come and visit Heather all afternoon. She's going to be here till, but come by the extension booth. We're in 216. Tent number or location number 216 this year. So don't go to the old spot, come to the new spot. It's better. How's that for vague? Thanks everybody, and get those questions coming in. Bye.